For decades, the world has known China as an unstoppable economic force. It built cities faster than anyone in history. It lifted hundreds of millions out of poverty. It became the factory of the entire planet and a rising financial superpower. But beneath that image of strength, something dangerous has also been quietly building. Not a market crash, not a trade war, but a hidden chain of debts, risks, and systemic cracks. A financial time bomb buried inside the world's second largest economy. Today we're taking a look at the 5 factors that could cause that bomb to go off and why the shock could reach every corner of the globe. China's skyline is a testament to decades of ambitious infrastructure building, glittering skyscrapers, vast highways, high-speed rail connecting bustling cities. But beneath this modern grandeur lies a troubling reality. A mountain of debt quietly amassed by local governments that could shake not only China's economy, but the global financial system. For years, Beijing pushed growth through infrastructure. Provincial and municipal leaders were rewarded for delivering rising GDP, and the easiest way to achieve that was to pour money into building airports, stadiums, bridges, industrial parks. The catch? Local governments in China have very limited power to raise revenue through taxes. Instead, they leaned on something called Local Government Financing Vehicles, or LGFVs. LGFVs are essentially special-purpose entities created to borrow money on behalf of local governments. They allowed officials to fund massive projects without those debts appearing directly on the government's official balance sheet. On paper, the finances looked manageable. In reality, the obligations pile up in the shadows. The size of this hidden debt is staggering. Official statistics don't tell the full story, but independent analysts estimate that China's local government debt now exceeds $12 trillion, which is more than the entire GDP of Japan, the world's third largest economy. The off-balance sheet borrowing worked as long as land sales kept generating cash. For years, local governments made money by selling land use rights to property developers who were eager to buy and build. But with China's property market now slowing, that revenue stream is drying up fast. The debts, however, remain. Because LGFVs operate in a grey area between public and corporate finance, the debt they issue is often intertwined with China's broader banking system. Domestic banks, many of them state-owned, hold large amounts of LGFV bonds. That means if these vehicles start missing payments, the shock could ripple through the financial sector. The problem is not just the size of the debt, but its opacity. Investors, analysts, even policymakers outside Beijing can't see the full picture. Because so much of it is hidden in quasi-corporate entities, assessing risk becomes guesswork. And in financial markets, uncertainty is often as dangerous as bad news. The moment a few LGFVs fail to roll over their loans, fear could spread rapidly, first through domestic banks, then to global investors who have exposure to Chinese bonds. The stakes are high because local government debt is not just a technical issue, it's tied to the credibility of Beijing's economic management. For decades, China's leadership has projected an image of control, a steady hand guiding growth, keeping markets stable. If local governments begin defaulting on a large scale, that image could crack. And in a country where public trust is closely linked to political stability, even a small crack can have outsized consequences. For decades, China's property market has been more than just a sector of the economy. It has been the most single important pillar of national growth and personal wealth. When we count both direct contributions from construction and indirect effects like steel, cement, home appliances, and local government revenues from land sales, real estate makes up as much as 30% of China's GDP, one of the highest shares anywhere in the world. For many years, this was a story of unstoppable expansion. Vast new apartment complexes rose in cities large and small. Cranes dotted skylines. Local governments auctioned off land to developers, collecting massive revenues that helped fund infrastructure. And for Chinese households, buying property wasn't just about having a place to live, it was the default investment strategy. In China, nearly 70% of household wealth is tied up in real estate, a much higher share than in most developed economies, where people also hold stocks, bonds, and pensions. Apartments became the primary savings vehicle, especially because the stock market is volatile and formal pension coverage is limited. Parents often buy homes for their children as part of marriage expectations, further inflating demand. But China's property boom had a secret. It was built on borrowing at an unprecedented scale. Developers like Evergrande, once the world's most valuable real estate company, became famous for an aggressive growth strategy, buying up land far in advance, starting multiple projects at once, and financing it all through bank loans, bond sales, and pre-sales to homebuyers. At its peak, Evergrande had more than 1,300 projects in over 280 cities and owed over $300 billion to banks, suppliers, and investors. This debt-fueled model worked as long as property prices kept rising and sales remained brisk. But by 2020, the government, worried about overheating and systemic risk, introduced the 3 red lines policy, stricter rules on how much developers could borrow relative to their assets, equity, and cash flow. That was the turning point. When sales slowed, companies like Evergrande suddenly found themselves unable to roll over debt or start new projects. Pre-sales, which were a critical source of cash, dried up as buyers lost confidence. Suppliers went unpaid, construction stalled, and homebuyers in some cities even staged protests, refusing to pay mortgages on unfinished apartments. By late 2021, Evergrande defaulted, the largest corporate default in China's history, sending shockwaves through the property sector. Other major developers like Country Garden and Sunac began to face similar liquidity crunches. By 2024, property sales had fallen by over 20% from their 2021 peak, and new construction starts had dropped to their lowest level in more than a decade. For millions of Chinese families, their home was not just a place to live, it's their retirement fund, their inheritance for their children, and their emergency safety net. A falling property market strikes directly at the heart of household wealth. In 2025, in many smaller cities, prices are down 15 to 20% from their highs, wiping out years of gains. Even in Tier 1 cities like Beijing and Shanghai, growth has slowed to a crawl, with some districts seeing modest declines. When people feel poorer, they spend less. Youth unemployment rates hover above 14%, and consumer confidence, already shaken by years of COVID lockdowns, have taken another hit. Weak consumption makes it harder for Beijing to rebalance the economy away from investment-led growth. The real danger is not a sudden collapse, but a drawn-out stagnation in property values similar to what Japan had experienced. A protracted property bust would mean years of weak sales, slow price declines, and cash-strapped developers struggling to survive. This would weigh heavily on GDP growth. Remember, real estate is almost a third of the economy and could trap banks with piles of bad loans tied to over-leveraged developers. More subtly, it erodes faith in one of the central pillars of China's economic model, the belief that property values always go up. If that belief dies, households may stop buying altogether, creating a self-reinforcing downturn. Another factor undermining China's financial stability lurks in the shadows. Beyond the brightly lit branches of China's state banks lies a vast and largely unregulated financial network known as shadow banking. It's not a single institution, but an intricate web of trust companies, wealth management products, entrusted loans, and even underground lending operations that operate outside the formal banking system. On paper, these products can look professional. Glossy brochures, polished sales pitches, and promises of steady returns give them an air of credibility. But behind the marketing, the reality is much riskier. Much of the capital raised is funneled into property developments that banks won't touch, or local government projects with questionable prospects of repayment. These range from industrial parks and bridges to entire new districts that may never reach full occupancy. What makes this even more concerning is the source of the funding. A significant share comes from middle-class households, not professional investors. For millions of Chinese families, shadow banking products seemed like a safe way to grow their savings, safer than the volatile stock market and offering better returns than standard bank deposits. Many bought in under the assumption that the state would step in if anything goes wrong. In China, this belief in government protection runs deep, but there is no blanket guarantee, and when defaults occur, investors often discover that the safety net they thought they had doesn't really exist. This has already played out in high-profile cases. In 2023, the Zhongji Enterprise Group, one of the country's largest shadow banking conglomerates, announced it could not repay billions to its investors. Many of those left in limbo were ordinary citizens, now facing the loss of life savings they'd spent decades building. The scale of the problem is hard to overstate. At its peak, the shadow banking sector in China was estimated to be worth over $12 trillion, roughly equivalent to the GDP of the entire European Union. Even after years of regulatory crackdowns, it remains a multi-trillion-dollar force, and because it's so deeply intertwined with real estate financing and local government debt, two areas already under heavy strain, it sits in a dangerously exposed position. Opacity makes this threat even harder to manage. Official statistics fail to capture the full picture. Many of these loans are disguised through investment products or shifted between entities to avoid regulatory oversight. Analysts have to rely on leaked documents or patchwork research to estimate the real size of the market. The government has been trying to rein shadow banking in since 2017, forcing trust companies to cut exposure to high-risk sectors and bringing more activity under formal regulation. But it behaves like water. Wherever you block one channel, it finds another path. New structures emerge to replace the old, keeping the system alive. If a chain of defaults begins here, the damage will not be limited to balance sheets. It could ignite protests from angry investors, accelerate the outflow of capital from China, and challenge Beijing's ability to maintain public confidence in the stability of the financial system. And once that confidence is shaken, the effects could spread faster than any regulator can contain. And the trouble doesn't stop there. Once you step out of the murky world of shadow banking, you run straight into another ticking time bomb, the on-balance sheet corporate debt. For years, China's companies gorged on cheap credit. Interest rates were kept low, banks under political pressure to lend, and local governments were eager to keep factories running and jobs in town. The result? Thousands of firms should have gone bankrupt years ago are still standing. Economists call them zombie companies. Businesses that generate just enough cash to cover interest payments, but not enough to pay down their debt, innovate, or grow. They exist in a kind of economic limbo, surviving only through constant refinancing. Many of these zombies are not small players. They are state-owned enterprises that dominate China's heavy industries: steel, coal, shipbuilding, and construction. On paper, they are national champions, but in reality, they often absorb massive amounts of capital while delivering very little in return. Because they are politically important, providing jobs and sustaining local economies, banks keep lending to them, even when it's clear they will never be competitive without state support. The problem is that the easy credit era is over. Rising borrowing costs, both domestically and for overseas debt, are now putting intense pressure on these firms. Even a small increase in interest rates can tip a heavily indebted company into default. This is especially true in manufacturing and heavy industry, where margins are already thin and global demand is slowing. In recent years, we've already seen cracks forming. Defaults by large firms are no longer rare headlines, they're becoming more common. Some have been quiet, handled through orderly restructuring. Others have been loud and messy, involving bondholder losses and even public protests from unpaid workers. The scale is daunting. By some estimates, corporate debt in China now amounts to around 120% of GDP, one of the highest ratios in the world. And while not all of that belongs to zombies, a significant share is tied up in companies that are simply treading water. If rising borrowing costs continue and global demand stays weak, many of these firms could finally collapse. That would not only mean losses for banks and investors, but also a direct hit to employment. Entire towns and industrial regions can rely on a single plant or mine for jobs. And if that goes under, the social impact can be immediate and severe. In this way, the zombie company problem isn't just about inefficient capital, it's about widespread corporate failures that could spike unemployment and deepen China's economic slowdown. When you combine that with the fragility of the shadow banking sector, the risk of a cascading crisis becomes impossible to ignore. The next pressure point in China's financial time bomb is written into the country's population chart. For decades, China's explosive growth was powered by the largest workforce the world had ever seen. But in 2022, that story changed. For the first time in over 60 years, China's population actually shrank. That year, India took the title of the world's most populous nation. The math is brutal. China's fertility rate sits around 1.3 births per woman, far below the 2-to-1 ratio needed to keep the population stable. In 1980, the average Chinese family had more than 2 children. Today, even with the one-child policy long gone and government incentives like cash bonuses, housing subsidy, birth rates continue to fall. In some cities, the cost of raising a child has become so high that young couples are opting out entirely. The consequences are already showing up in the workforce. China's working-age population, those between 15 and 59, peaked more than a decade ago and has been shrinking ever since. Now in 2025, there are millions fewer workers than just 5 years ago, while the number of people over 65 is climbing fast. Demographers project that this over 65 group will double by the mid-2040s, swallowing an even larger share of national resources. This is an economic time bomb. An aging society means higher pension payouts, more strain on healthcare systems, and fewer taxpayers to foot the bill. The government already spends heavily to keep pension funds solvent, and as the ratio of workers to retirees collapses, those costs will soar. And then there's consumer demand. China's rapid growth over the last 30 years was fueled by hundreds of millions of young workers moving to cities, buying homes, cars, and electronics. But older populations tend to spend less, especially on big-ticket items. In 2025, retail data already shows slowing demand, especially in sectors tied to younger consumers like smartphones and property. The link to the financial system is direct and dangerous. A shrinking workforce means slower GDP growth. Slower growth means lower tax revenue. Lower revenues make it harder to service China's already massive debts, from local governments to state-owned enterprises. In other words, demographics aren't just a social issue, they feed directly into the same debt crisis we've been uncovering so far. Finally, there's one other factor that could speed up China's financial time bomb: geopolitics. US-China tensions are no longer just about tariffs or technology, they now threaten a full-scale financial decoupling. In an extreme scenario, US investors could be forced to sell around $800 billion worth of Chinese equities, unwinding decades of cross-border capital ties. Trade restrictions and sweeping tech bans are also forcing China to turn inward, leaning more heavily on debt-fueled domestic stimulus to hit growth targets. But that's a dangerous game. Debt-driven growth is exactly what inflated many of China's current financial risks in the first place. And then there's the currency dilemma. The yuan remains tightly managed, but Beijing faces a lose-lose choice. A major devaluation could trigger massive capital flight, while keeping it artificially strong risks hurting already strained export. Both scenarios chip away at investor confidence. The risk is clear. Once that confidence is shaken, outflows can accelerate quickly, draining Beijing's financial defenses right when it needs them most. So what happens if China's financial time bomb finally goes off? Domestically, the shock would be immediate, cascading defaults across local governments, property developers, and corporate giants. Unemployment would spike, and with it, the risk of social unrest in a country used to enforced stability. But that shock wouldn't stop at China's border. Across Asia, economies tied to Chinese demand from South Korea to Vietnam would see growth stall. Commodity exporters from Australia to Brazil would watch prices for iron ore, copper, and oil collapse, pulling their budgets into crisis. And global investors would be forced to absorb massive losses from China-linked debt equities, shaking confidence in emerging markets as a whole. In the short term, Beijing will keep the system afloat. Bailouts, currency controls, and targeted stimulus are its go-to tools. In the medium term, expect slow-motion deleveraging and debt restructuring, but at the cost of weaker growth. And in the long term, well, without deep reforms like smarter capital allocation, curbing shadow banking, and adapting to an aging population, the explosion becomes a matter of when, not if. The truth is, China's economy is too big to collapse quietly and too entangled with the world to fail without global consequences. The question isn't whether the shock will be felt, it's whether anyone is truly prepared for it.